welcome Suzanne Mellen to the podium, please.
Good morning. Thank you. I'm going to give you an overview of U.S. hotel transactions this morning and what the outlook is going forward. And following on the heels of Jan and Mark, 2013 was a banner year. The data that I'm presenting to you on hotel transactions is derived from RCA, Real Capital Analytics, who track transactions of all real estate, and we focus here, of course, on hotel assets. And in this particular slide, they actually researched sales at the $2.5 million price point up to and above. And this slide tracks the total transaction activity of individual sales of individual assets and portfolios, and it excludes the sales of entities such as Motel 6, for example, because it's hard to carve out the business and franchise component of those transactions. So you can see that 2013 transaction volume increased significantly, reaching about $25 billion, which was still below the prior peak of about $33 billion in 2006, but still rising significantly. And you can see that the average price per key has risen very strongly to about $140,000, exceeding the prior peak of about $132,000 a key in 2006. What's interesting is when you look at the breakdown in what comprises the total volume, and we define it as $2.5 million to $10 million in purchase price, and then $10 million and over, as really two different worlds, if you will. The activity in the $10 million and over mirrors that of the total market, and $10 million and over comprised about 80% of the transactions. Total volume about $20 billion, and average price per key $204,000, exceeding the prior peak per key. What's interesting is the $2.5 to $10 million range, and you can see that it's a very different trajectory in this level of the market. It didn't experience the volatility that was felt in 2012 because in this section of the market it's not as tied to the capital markets, and so it's not as volatile. And you can see that there's been just a gradual upward trajectory in transaction volume. And the average price per key, though, has actually lagged. And it's interesting, if you think about it, this $10 million price point, if you will, is really kind of artificial. It was something that we set up in the early 1990s, looking at transaction activity of $10 million and over. And if you think, since the early 1990s, there's been a significant amount of appreciation and inflation. And so as prices rise, the types of properties that are in that $2.5 to $10 million category obviously end up being smaller or lower priced facilities. And so it has a different profile than the larger hotels at $10 million and over. In comparison to sales volumes really it tells the story. You can see that again that greater than $10 million purchase price comprises the majority of the market. In terms of the activity, the volume of the larger hotels over $10 million increased 45% in 2013. Very dramatic increase in volume. For the $2.5 to $10 million category, volume activity increased 33%. Very robust all across the board last year. In terms of the number of properties sold, however, you'll see that the $10 million and over were 467 assets total, still well below their peak in the 2005 through 2007 period, whereas the $2.5 to $10 million asset category, 893 transactions, and as high, actually exceeding the levels reached in 05 and 07. So you can really see it's a tale of two different worlds. Number of activity of transactions up 23% for $10 million and over, and 31% for $2.5 to $10 million. Now, just looking at $10 million and over, you can see that the total sales price by price paid from in the $10 to $25 million category comprised 56% of the number of transactions in 2013, but only 19% of the volume. And for example, hotels exceeding $200 million in a total single asset purchase price represented 7% of the number of hotels sold, but 28% of the volume. So you can see that these numbers swing significantly depending on what types of hotels sell, how big they are, and how high the price is per key. And this really tells the story of the increase from 2012 to 2013. You can see that in 2012, there were about 120 hotels that sold for less than $100,000 per key, and about the same number in 2013. But if you look at the upper end of the spectrum, in 2012, only 3 hotels sold for more than $750,000 a room, and that increased to 11 hotels in 2013. Same with the number of hotels that sold at $500,000 to $750,000 a key, increased from 11 to 20, more than doubling. And so we're seeing a lot more significant assets, very high price per key, larger assets selling in 2013. Just some examples of some hotels that have sold. People are always asking, well, how many hotels do you know that have sold for over $1 million a room? And in the last 5 years, there really haven't been any, and so it's been a very rare thing to see that kind of price point. Well, in 2013, there were 3 hotels that sold for over $1 million a room. The Park Lane and Langham in New York, no surprise, in Manhattan, and the Calistoga Ranch, a boutique resort in Calistoga, Napa Valley, California. So we've got those nice comps for people in the market. What's been interesting is that the resort market, which had been very slow over the last few years, almost no transactions, is starting to finally revive itself. And we're going to see more of that in a little bit. Grand Wailea was one of those sales, and the 3 sales in total purchase price, asset purchase price, over $500 million in a single asset sale. And the Grand Wailea transaction at $774 million is the highest price for a single hotel asset that we're aware of to date. As I mentioned, resorts have increased their transaction activity. Omni entered the market, resort market in a big way, buying 4 resorts from KSL. Very significant prices and prices per key. GIC Singapore entered the resort market as well, buying a portfolio for $1.5 billion, which included these 3 resorts, the Biltmore, La Quinta, and Grand Wailea. Again, that Grand Wailea sets the new record for price paid for an asset. Now, GIC was a lender, had some debt on these properties, and they actually bought these out of bankruptcy court and were the only ones that submitted a bid. So, of course, the question becomes, if they hadn't had some debt on these properties, what would these purchase price have been if they hadn't come to the table? So that's just something to think about. But these are the kind of sales that have really driven up the volume this year. Top 10 active markets by volume. New York, no surprise, Hawaii, San Francisco, Miami, in terms of over $1 billion in transactions. In terms of the number of properties sold, Dallas, Fort Worth, 59 hotels, Miami Metro, 51, and Houston, LA, and Atlanta, over 40 transactions. This is $2.5 million and up, I should explain. It's been interesting to see the trend in hotel buyer composition. In 2009, the blue private equity stepped in that down year, and then in 2010, equity funds stepped in, stepping in to buy hotels at their low point. And then the REITs started coming back in 2011. You see public funds dominated the market, and then the last few years, private equity has stepped up to become the primary buyer in the market again. Top buyers and sellers, the REITs were very active. Some REITs like Host and Sunstone were buying and selling. We had mentioned, let's see, Blackstone bought a $1 billion portfolio from Apple REIT. Omni, we mentioned that transaction. And I'm just going to move through this. You can have a copy of this and look at it at your leisure because I'm running out of time. One big driver to transaction activity is the amount of capital out there, the debt capital. The CMBS market has been very active, I'm sure you're all aware, driving down competing. Lenders are competing with CMBS lenders, and so there's a lot of competition, which is reducing the spreads and making interest rates very favorable. They actually were very low at the beginning of 2013, rose a little bit, and then have come back down. Someone told me about a Holiday Inn Express where they got 18 term sheets from lenders to provide financing on a Holiday Inn Express. Amazing market in terms of debt, which provides the liquidity to the market. Just looking at cap rates now, these cap rates are produced by PricewaterhouseCoopers Real Estate Investor Survey, and there are a lot of surveys out there that survey investors about what kind of cap rates they want or look to purchase assets at. And you can see here, they've been very steady over the last few years. The prior slide, which I just zoomed past, showed the top 4 lines are hotel cap rates, and they are still a nice premium over the other cap rates for other kinds of real estate, which is why capital is so attracted to our industry. Hotel cap rates have remained very steady over the last few years, even though one would think as income starts to rise, maybe it's a little different than Mark does, I think, believe survey cap rates, right? Right, yeah, that is, yeah, historical. And this is also survey that they've remained very steady, even though net incomes have been rising. And the top line, limited service, the bottom 3 lines are select service is the yellow, and the blue and red is luxury and full service. And you can see that the premium that luxury hotels had over full service hotels has actually gone away since the recession. Now, HVS, when we appraise a hotel, at the time of sale, we derive cap rate and yield data from those transactions. So it's a very different thing deriving a cap rate from an actual sale as compared to a survey cap rate. Survey cap rates, you can see, we're more in the 8% range, and same with Mark, more in the 8% range. From actual transactions, you'll see here that a little bit different for different price categories. Full service hotels, this is over 11, 12, and 13. I'm just showing how stable cap rates have been, and these are from actual sales transactions. Full service luxury hotel cap rates have been in the 6% range. Select upscale, select service and extended stay in the 7 to 8% range, and limited service in the 9 to 10% range, very consistent. This slide shows comparative rates of returns. The cap rates all the way to your left are based on historical net income. That's historical net income divided by the purchase price. First year projected net income is the next set of columns. Then the overall unleveraged discount rate, ranging from 10% or so for full service luxury assets up to about 13% for limited service. And then equity yields that we derive from the transactions, 17% for luxury full service and up to 20% for limited service. And these have also remained fairly consistent over the last few years. So I just wanted to put one thing in here in terms of one of the things that we look at when we derive these cap rates is capital improvements. And it's really kind of the big elephant in the room. When somebody buys a hotel, for example, on a 10 cap, which is their net income divided by the purchase price, and then you find out that the PIP upon sale, the brand is requiring that they invest a certain amount of money to sustain the brand and just to sustain the income, and you factor in what they're going to have to put into the property in terms of capital improvements, all of a sudden that rate of return or that cap rate might go down to 8 or 9. And so it's really something that people are encouraging to look more closely at when they put together their exit strategies for their investments, because you have to be concerned with what is going to be the age of the asset when you look to exit the investment in a few years, in addition to interest rate risk. So we're finding more people are focusing on their exit caps when they're doing their discounted cash flow analysis. And I just created this line to show the aging stock of the U.S. hotel, of the U.S. hotel inventory, basically. The light blue line is actually the percentage of total revenue put into capital improvements over the 25-year lifespan of a hotel. And this is derived from the ISHC 2000 CapEx study and based on actual data from hotels. And the blue line is the current stock in terms of thousands of rooms of the age along the bottom of the slide, which I obtained from Smith Travel Research. So you can see right now that hotels built in the last investment cycle are still fairly young. We have many, many hotels, actually the biggest bulge of hotels that were built in the 1984 through 1990 that are already 25 to 30 years old and are already experiencing significant needs for capital improvements to extend their economic life. And if you look over time, 5 years from now, you can see that the age of these assets shifts, that they're going to require more and more capital improvements. And 10 years from now, that the stock of U.S. hotels now will be considerably older, and that investors will have to be concerned with that, not when they buy and when they sell. And really quickly here, I know I'm running out of time, sorry. Outlook for 2014, we expect it all depends on what assets sell. A lot of people that we've talked to have pulled out of the market because they're thinking that the prices are a little bit too frothy for them. But the high prices that we're seeing in the market are going to attract, we think, a lot of new people, sellers to the market who will put their assets up for sale, which should lead to a strong transaction yield. The debt ceiling fight in the spring and other uncertainties may derail the market. So this quantitative easing that we've been hearing about may slow things down, but hopefully not. A wide array of buyers will continue to pursue investments. More sellers will come to the table because of the high prices that it'd be a good time for them to exit their investments. Availability of debt is expected to continue and create downward pressure on interest rates, even though interest rates are expected to continue to rise. And no one that I've talked to is expecting any major interest rate increase over the year, but there may be some. And we expect capitalization rates to remain steady, even though net income is continuing to rise because of the availability of significant amounts of debt and equity capital. So overall, we're looking for another robust year in 2014, barring any unforeseen events that can shake things up. Thank you.